Hello, my name's Gosselin from Australian Fund Monitors. At AFM, we monitor and research over 400 actively managed funds, either available in Australia or managed from Australia. And what we often find is people say to us, what is the best fund? The difficulty is there is no such thing as a best fund because it depends on the requirements of the individual investor. What may be a really good fund or a really suitable fund for one investor may be completely unsuitable for another. So investors tend to fall into the range of either wanting a return for a certain amount of risk, or they're risk averse and they're prepared to accept a lower return for that. But it's still really difficult to actually make your fund selection. Quite often it's a case of actually putting the right basket of funds together in a portfolio so you get some diversification, and we'll talk about that later. But the core of the whole situation is that you have to look for data. And although ASIC say, and all the advice says, you shouldn't look at past performance because it's no indicator of future performance, one of the major things that advisors look at and investors look at is how has a fund performed in the past? Because without looking at the past performance, you can't really get an idea of how the fund tracks or how the fund is managed in different circumstances. So just hang around for a moment and we'll go through a range of things you need to look at when selecting managed funds. So before you even start to look at the performance and the risk criteria and KPIs of a fund, you need to look at manager selection and strategy selection. So there needs to be an understanding that you want a diversification of strategy. There's no point having all your funds, literally all your eggs in one basket, all your funds in one portfolio being the same. No point in doing that at all. So you need to work out and establish the geographic diversification you want, the strategy diversification you want. And it may be that you're looking for a specific type of fund, specific strategy to balance other aspects of an investor's portfolio. Or it may be that you're wanting to put together a portfolio of managed funds as the majority of your investment. So looking at that, there are a whole range of different strategies that you can look at. There are obviously long-only strategies, long-short, market-neutral. You've got different asset classes, equities, commodities, fixed income. All these facets come into play when looking for or looking to build a portfolio of managed funds. You also want to look at what's the correlation between funds. You want to look at the duration of the funds, what's the liquidity of the funds. Everything that needs to be looked at is available through the Fund Monitor's website. And by doing that, you can create a portfolio that meets the requirements, and then you look for your fund selection of which fund has the performance criteria you're looking for and which fund has a risk criteria or risk performance that you're happy with. Having established the sort of diversification you want in your portfolio, by diversification we're looking at geography and strategy, style, liquidity, then you need to have a look at the individual funds. And obviously the first thing you look at is performance. How has the fund performed over short, medium and long term? And how has the fund performed in varying market conditions? Performance itself actually is made up of a whole range of different characteristics or KPIs. So there's obviously the headline performance of percentage return per annum over a period of time. But there are also a whole range of other criteria you need to look at, particularly in the risk area. Risk is so important in any portfolio, in any investment obviously. And you can range between a high risk, high performing type strategy to a low risk, steady strategy. Obviously fixed income is much lower risk than equity investments. So in looking at that, what are the criteria we look at? From a risk perspective, then there are a whole range of characteristics. So you can look at What is the volatility of a fund? Volatility is probably the easiest to measure. How volatile is the monthly performance of that fund over time? The more volatile the fund, generally speaking, you should be looking for a higher performance. But a lot of investors won't want a lot of volatility in their funds. But there are a whole range of other criteria on the risk side of the equation that are important. If you look at the volatility of the fund, it's also worth looking at what is known as the Sharpe ratio. The Sharpe ratio is a well-established formula for working out how much risk a manager is taking in delivering a certain amount of performance. The Sharpe ratio was developed so that you could compare apples with one number. It's not perfect. It's a good generalization, and you're looking for a Sharpe ratio of 1 or more if you can possibly get it. So what it does is it takes the performance less the risk-free rate, cash rate, divided by the volatility to give you a Sharpe ratio. There are other ratios as well, Sortino ratios. These are all useful, but they're very much a headline type indicator. Other things you should look at is the maximum drawdown. In periods of negative return, either for the market or for the fund, how far has the fund's performance dropped? Bear in mind, the greatest risk that any investor faces is the permanent risk of loss of capital. You can have a certain amount of volatility in a fund or a portfolio, but the worst thing you can possibly have is permanent loss of capital, because that takes a long time to catch up again. Some of the other factors we look at which I think are really important are up capture ratio and down capture ratio. As the name suggests, one's the opposite of the other. The up capture ratio looks at how much does the fund return during periods of positive market performance. So if the market's going up 10% per annum, how much is the fund going up? Is it capturing the upside of the market? The downside or down capture ratio does exactly the same. When the market is falling, how far does the fund fall? Now, an up capture ratio of 1 indicates that for every 1% that the market rises, then the fund rises 1% as well. That's good, it's capturing the upside. But you've got to look at the downside as well and the down capture ratio. So when the market falls 10%, how far is your fund traditionally or typically falling? And you're looking for a down capture ratio of less than 1 or less than 100, depending how you look at it. 100% downside means you're capturing all the downside and you really don't want that. In an ideal world, you want an up capture ratio of more than 1 and a down capture ratio of less than 1, but that's difficult to achieve. If you're really looking to be risk averse, look at the down capture ratio, because when markets go down, you're at risk of losing capital. If you can find a fund that on down capture ratio has a low ratio number, then that's well worth looking at. At the end of the day, investing in a single fund or a single manager is risky. You can do it, and we see a lot of investors who have single funds in their portfolio or their entire portfolio is a single fund. But in order to do that, you're taking single manager or single fund risk. And we all know that diversification is the best way of avoiding risk. With managed funds, it's no different. If you can diversify the funds within a portfolio, you are going to significantly reduce the risk you have of any one fund losing or having a drawdown at any one stage. Having said that, you've got to make sure that there's no correlation between the funds. There's no point, for instance, putting a portfolio together of 5 funds if they're all invested in the same asset class or invested in the same region or investing using the same style and have a high correlation. You're just going to get the same thing 5 times over. You'll get some diversification of manager risk, but you're unlikely to get much diversification of performance risk. So diversification and correlation go together. And whenever you're looking at a portfolio, ensure that the strategy and the geography and the style and the manager or the funds are diversified. So you're getting that benefit. But look at the correlation and make sure there is a low correlation between the funds. And what you will find is by putting a portfolio of different funds together that have low correlation, you can put together a portfolio with good performance with significantly reduced volatility. And that's the key to it. If you can reduce the downside, your investors will generally thank you for it. A performance of 10 or 12% per annum with a volatility of 5 or 6 is a good result, particularly in the current times of low cash rates and low returns. Obviously, if you can increase the performance without excessively increasing volatility, terrific. But by putting those funds together, measuring volatility, looking at the individual funds and selecting those with an attractive down capture ratio, an attractive up capture ratio, you'll have a portfolio that your clients will thank you for. It will have a good return and it will have low volatility. There's nothing worse than having a client on the phone or in front of you and you having to apologise for the performance of funds that you've selected for them. In summary, it's worth thinking about why you would invest a client's funds in managed funds rather than individual equities or individual investments. And in a way we've covered that, it's diversification. If you can put together a portfolio of 5 or 10 managed funds which have low correlation, then you in fact get extraordinary diversification. So you put together a global fund, an Asian fund, some local funds, fixed income. Think about the number of positions that are being managed for you. So even concentrated funds with 25 or 35 positions in them, by the time you have 5 funds or 10 funds like that, you have incredible diversification across a whole range of industries and a whole range of styles and a whole range of strategies. And that's extraordinary because you do get diversification. Markets will go up and down, understandably. Select your funds correctly, ensure that they've got a low downside capture ratio, ensure that they are relatively low risk, and when you're putting them together as a portfolio, there is good diversification and low correlation. And you can find a portfolio that will suit any range of number of your clients, meet their return requirements, but most importantly, meet their risk requirements.